Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at three impressive stocks to consider buying on a rather large dip heading into July that are all trading at least 30% below their all-time highs. And those three stocks are Ulta, Semiconductor, and Lululemon. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look in some of our services, portfolios, and more. So before we jump into these three stocks, I quickly just want to go over where the market stands as we close out the first half of 2024 and head into the second half and the start of July. I'm recording this on Thursday afternoon. The market was slightly positive for the second day in a row after ending a 3-day skid earlier this week, with the bulls holding the line at the 21-day moving average once again, after, as I said, NVIDIA and a few of those big tech stocks pulled back just down to some moving averages. Once again, that 21-day has proved to be the line in the sand the bulls are going to hold. The big near-term results that people are going to be paying attention to by the time you're listening to this, perhaps we'll already have the PCE data, which is the Fed's preferred inflation gauge that is out Friday morning. And it's kind of hard to imagine that the PCE data moves the market unless it comes in really cool or really hot. So that's kind of, we're going to be in a sort of a lull period heading into the week of 4th of July, where a lot of people are going to be off their desks. So the market could be pretty low volume, especially in the back half of the week, as we then head into what will be the busy part of Q2 earnings season that week after we get back, with the big banks kicking off the heart of Q2 earnings season on Friday, July 12th. So that's kind of where we are at the moment. There was a little bit of a pullback. The bulls held the line at the 21-day moving average. We might see possibly some more near-term profit taking to maybe set up for a more bullish second quarter earnings season, since we are still up really significantly. We had a stellar first half of 2024 driven by, as everyone knows, big tech stocks driven by that AI boom. And if we look at the evolution of tech earnings estimates, they're up significantly over the last year. And for the full year, tech sector earnings are expected to be up by 17% in 2024, with impressive all-time high margins at 25.1%. So, and that's up from all-time highs of last year of 23.7%. And if we look in the pre-COVID era, the highs were roughly 20% for an extended period of time. So we're in a new uncharted territory with massive margins for tech stocks and huge earnings growth, which is why the market's up so big, dominated by tech. And then if we look overall, S&P 500 earnings are expected to climb 9.1% in 2024, and then jump another 14% in 2025, and then 12% in 2026. So that's kind of the bull case right there, along with expected interest rate cuts in the back half of 2024. That's why the bulls remain firmly in control. So even if we do have a pullback, say, before or after Q2 earnings season, investors likely want to start looking at their favorite best-in-class stocks to buy on the dip. And with that in mind, though, we're now looking at three S&P 500 stocks that are trading at least 30% below their highs that investors might want to start looking at, with some of these big tech names and the broader market looking a little overheated at the moment after this really stellar first half of 2024. And the first of these three stocks we're going to look at today is Lululemon, which trades the ticker LULU. It's a company that really did help change the fashion industry in meaningful ways over the last decade plus and going forward. And it spurred an entire new way people dress, fueling Nike and many other copycat athleisure companies to enter the fray. The stock has tumbled in 2024. In fact, it's the worst performer in the S&P 500 so far this year. It's down 40% year to date. The fall has come as the firm offered slightly lower than projected guidance, and many are worried now that in the fickle world of fashion, its days are numbered in terms of its massive growth and relevance, especially here in the United States and North America. Lululemon is getting hit by different sides. There's now these newer upstart brands that are on its corner. That's Hello and Viore. They're in that high-end yoga wear, athleisure space. And then there's obviously the lower end at places like Target and various other offerings that are all coming for its spot. But those two big ones are slowly eating at its market share here in the U.S., especially with its core female consumers. Some are then obviously worried about the slowing economic environment overall, that it's going to hurt companies like Lululemon who are selling really expensive clothing. And people are now, just getting a little worried that they're not going to be able to continue to grow massively with what has been its core growth base in the U.S., which are younger women in that key demographic. And then on top of that, the law of large numbers is necessitating that their growth is going to slow down on a year-over-year basis just as they get bigger and bigger. So that's kind of where we are at the moment. And then people are also worried that their chief product officer left earlier this year, and they're going to now have to adapt in a new world as they're facing more competition with trying to push product in an innovative way. So that's kind of the bear case for the stock at the moment. So all of these concerns have Lululemon down 40% year to date. So let's kind of dive into why investors might want to still consider buying Lululemon at this, what I see as a really discounted price, down 40%, and its valuation, which we'll get into in a minute. So the company really did change the way millions of people dress, forced Nike and many others to roll out their own athleisure styles for men and women. And as we said, Alo and Vuori are now trying to essentially copycat exactly what Lululemon did and go after the exact high-end, higher-income consumers, especially on the women's side of the business here in North America. It's now selling a range of clothing fit for the gym, the office, date nights, golf course, all of that. And it's been able to grow really impressively at various economic stages over the last 10 plus years, with its higher income consumers really not as impacted as much by various business cycles and economic cycles. The company posted 19% sales growth in 2023, with international revenue up 54%. So that's where a lot of their growth is going to come from going forward. This came after it did 30% revenue growth in 2022 and 42% growth in 2021, in average 16% growth in the 5 years before that. It also posted 27% adjusted earnings growth last year, and this came after 30% growth in 2022. So with that in mind, the company then in early June topped our Q1 2024 earnings per share estimates, boosting its adjusted earnings on a year-over-year basis by 11%. Revenue was up 10%, so that's a big slowdown from overall 19% growth last year, and then the massive growth they had done the several years before that. And the key part here that is getting more people on Wall Street a little nervous was that its America's net revenue increased just 3%, with international sales up 35%. And then on a constant dollar basis, Lululemon reported 7% year-over-year growth in comparable sales. Its results, though, only confirm the fears about the slowing America's growth, because its comps growth in the region was flat for the first quarter. So that's not the greatest sign, but looking ahead, they're still expected to do massive growth as they try to reach new markets, especially internationally as well. And thankfully, the CEO of Lululemon said that the first quarter slowdown, especially in the Americas and the U.S., could be fixed by some mistakes that they made on their end. And overall, still, the company had a pretty solid quarter, and its gross margins increased 20 basis points to 57.7%. And the company topped our bottom line estimates, and its overall earnings estimates have remained relatively impressive over the last year plus. So if we look from where we were this time last year, its 2024 estimates up about 4.5%, and its 2025 estimates roughly where it was a year ago. So the stock's down 40%, but its 2024 and 2025 earnings per share estimates have hardly fallen to necessarily dictate that the stock would be down 40%. And then if we look ahead overall to what we're expecting for growth, we're calling for 11.5% revenue growth this year, and then another 10% revenue growth next year to get up to about $11.8 billion. And then the bottom line, we're calling for 12% adjusted earnings growth and another 10% adjusted earnings growth next year. And obviously, the top line growth is a slowdown from the last several years, but it's more in line with what it did in, say, 2021 and various periods before that in 2018 and in other periods. So it's obviously slowing down compared to that massive growth, and then the slowdown in the Americas business is the concern. But overall, the company is still expected to grow by expanding its other businesses. So the company has what it calls its Power of 3 x 2 growth plan. It calls for doubling its business and net revenues from 2021 to 2026 to get all the way up to about $12.5 billion And those key factors of growth include doubling its men's business, doubling its e-commerce business, and quadrupling its international net revenue compared to 2021. So that's where a lot of the growth is going to come from going forward, as it also tries to continue to remain competitive in that key space here in the United States with that key women's demographic. And then in terms of its profit margins, they're almost unmatched in the non-luxury apparel space. And then in terms of sales productivity, which is measured by sales per square foot, it falls short of, say, Apple and Tiffany, but it's really exceeds all of its retail peers. So it really is still a very strong company. It lands a Zacks ranked number 3 hold at the moment, and it's topped our earnings per share estimates for almost 5 years running. With that said, the stock's now down 40% year to date after hitting new highs at the end of 2023. It did pop after its early June release, but it's already given up all of those gains. And the stock is now down 15% over the last 3 years. It's now trading around where it was in June of 2020, following its post-COVID melt-up. The stock is still up 620% in the past 10 years to blow away the S&P 500, which is up 190%. And it's still up 70% in the last 5 years, despite that tumble. It's currently trading below its 50-month moving average for the first time since 2017, and at its most oversold RSI levels on a 10-year time frame since 2017, and various points in 2015 and 14 when the stock bottomed and then went on a massive run. And then if you look over the last 10 years, the stock is now trading on below its 200-week moving average, and it's at its most oversold RSI levels over the last 10 years. It's even below its COVID lows, and it's now, as I said, it's trading below its 200-week moving average, and this is really the first time it's remained below this average for an extended period of time at all over the last 5+ years until really 2017. So it's trading at pretty big discounts, and if you have the stomach to possibly deal with some more downside, I think Lululemon's worth considering. The stock trades at a 71% discount to its highs at 20.5 times forward earnings, which is also near its decade-long lows. This is also a 35% discount to its median and a discount compared to the S&P 500. It's also a discount, 14% discount to Nike, even though Nike is only up 140% left over the last 10 years, and Lululemon's up 660%. So really impressive valuation and price point to get into Lululemon at the moment. It also boasts a really stellar balance sheet with no debt, $1.9 billion in cash and equivalents, and its board authorized a $1 billion increase to its stock repurchase program. So at the moment, if you're heading into the second half of the year and the early days of July, you're looking for some stocks to possibly nibble at sitting at a deep discount, Lululemon is certainly a name to consider. And now we're going to move on to another one of these names to consider trading at solid discounts, and that is Ulta Beauty, which trades in the ticker ULTA. It is the largest U.S. beauty retailer, and the stock was soaring off its COVID lows as its revenue earnings soared amid a spending boom. Ulta has now chopped around a lot more over the last 2 years, including 2 huge roller coaster rides up and down. The stock's now trading around 33% below its all-time highs back in March. So let's see why investors might want to consider buying. So overall, the entire beauty category is experiencing weaker spending across price points and product segments. And this is what the company's CEO has said recently at its investor conference. He said, quote, "Things are going on in our consumers' lives that had led to a little bit slower growth than we anticipated in the category originally. So overall, comparable sales growth is slowing as people slow spending on things. They've been buying everything, including makeup and furniture, since that COVID boom. And now this summer, all you hear about is people spending on experiences and traveling and things like that. So that's hurting Ulta and other retailers in general. There's also competition from Sephora in its beauty space. And then overall, just the beauty space in general and the retail space has been hit hard by slowing consumer spending, especially on the lower end of the income spectrum here in the United States. And if we look at its earnings outlooks over the last year, its 2024 earnings estimate is down about 3.5% over the last year, and its 2025 estimate's down around 3.6%. So The stock's down 33%. So the stock's down 33% from its highs, even though its 2024 and 2025 earnings per share estimates are only about 3.5% lower over the last year. So that's not that much of a fall in terms of what Wall Street was expecting from its bottom line growth. And since its most recent earnings report, its 2024 and 2025 estimates are down just slightly. So nothing crazy shocking that would necessarily have spurred this massive downturn once again. So overall, we're calling for about 3% growth on the top line in 2024, and then another 6% growth on the top line next year. We are calling for a roughly 1% year-over-year drop on the bottom line this year, but then returning to impressive growth next year at 11% growth. This growth, it does come against, especially on the top line, really impressive stretch of growth. They did 40% growth in 2022, 18% growth in 2021, 18% growth in 2022, and then 10% growth in 2023 last year. And overall, let's then kind of look at why it might be worth considering buying Ulta at this point. So beauty has historically been a rather resilient space, specifically during times of economic uncertainty when people choose to still spend money on foundation and lipstick and things like that, despite broader macro concerns. So kind of like spending money on the small things to not feel like you're totally down in the dumps if the economy is turning for the worse. Ulta Beauty also began to really reshape the entire space back in the early 1990s by bringing everything under one roof. And it's really been able to grow impressively over the last 20 plus years as it sells everything from cosmetics and fragrances and skincare and hair care all in one. They also sell a variety of brands across various price points. They operate roughly 1,300 retail locations across the entire United States, and their e-commerce offers are gaining traction as well. The company's rolling out more how-to style videos and tips and tutorials online and various things. So overall, it's a solid business to be in, especially it's not going out of style anytime soon. People are not going to stop wearing makeup. Women are not going to stop wearing makeup. So now let's get back to the price performance. So it's down around 33% from its mid-March highs, trading around where it was in August of 2021. It seems to be possibly finding its lows. It's now finding its lows of where it was back in the fourth quarter of 2023. So then went on a massive run, and then it's fallen all the way back down to where it was back then. So it's essentially traded sideways over the last several years, and it's now below, though, its 50-day and 200-day moving averages. So a technical standpoint, not sitting in the most advantageous place, and it's trading slightly below its 200-week moving average for the first time since the initial COVID sell-off. It is also trading, though, at rather heavily oversold RSI levels over the last 10 years. So that could be a good place to get into Ulta stock. Overall, Wall Street's still relatively high in the stock. So 16 of the 25 brokerage recommendations that we have for the company are still strong buys, with 8 holds and only 1 strong sell. And overall, it's trading 25% below its average Zacks price target. And then in terms of valuation, it's trading at a 63% discount to its highs at 14.4 times forward 12-month earnings, which is also a 40% discount to its median and 12% below its industry, even though it's crushed its industry over the last decade, up 320% versus its industry's roughly 32% climb, and easily outpacing the S&P 500. So certainly worth considering Ulta amid this recent downturn, down 33% from its highs, even though its business should remain really stable and long-term trend towards growth. It's just coming up against a really impressive stretch of top line and bottom line growth over the last several years in that post-COVID boom. And now we're going to move on to a company outside of the broader retail and consumer spending space, and that is ON Semiconductor, which trades on the ticker ON. It operates in the highly important but less flashy analog industry within the semiconductor market. The company has been hit rather hard as growth slows for its key growth markets, which are EVs, energy storage, and things like that. The Semiconductor Solutions company is focused on the industrial automotive market. So that business is, as I said, slowing. So that's a big reason that the stock is now down 35% from its summer 2023 highs, while the chip sector has soared 101% over the last year. So if we look overall, the stock is up about 620% over the last 10 years versus its Zacks Semiconductor Industries roughly 1,000% climb, and a lot of its underperformance is due to its recent downturn. So it's fallen 35% from its summer 2023 highs. So last year, while the chip sector has gone on that booming run driven by AI expansion, and ON Semiconductor, unfortunately for it, is not benefiting from that boom. So that's the reason the stock is underperforming. And it's also happening because EV sales are slowing in the broader automotive sector, and industrial markets are slowing in general within broadly cyclical spaces. So if we look, and we should note the semiconductor industry is really cyclical in general as well. So if we look at the moment, ON Semiconductor's revenue is expected to fall about 13% this year, and then climb 10% next year, which is not totally out of the ordinary to see it have big boom bust cycles. And then on the bottom line, we're calling for its adjusted earnings to slide 26% in 2024, but then post 27% growth next year. So 2024 could be the near-term bottom for the company. Last year in 2023, its sales came in roughly flat. They were down about 0.9%, and this is after it did 24% growth in 2023 and 28% growth in 2021 after back-to-back years of downturns in 2019 and 2020. And if we look at its earnings estimate revisions over the last year, you can see this is why the stock has been hit relatively hard. So compared to where we were a year ago, its 2024 estimate's down 24%, with its 2025 consensus earnings estimate down about 17%. So that's why the stock has been hit relatively hard. You can see, if you look at a chart on Zacks.com, you can see its earnings estimates peaking when it peaked last summer, and then as they trended downward, the stock has just gone straight down since then. Obviously, there's been some peaks and valleys during that period, but overall, as I said, the stock's down around 35% from its highs. It's always, though, consistently beat our bottom line estimates. It's beat for the last 3+ years on the bottom line, so that's a solid trend. And the company CEO said at its April Q1 earnings release that as power continues to play a critical role in the world's increasing energy demands, efficiency is paramount, and we are positioned to continue to gain share with our portfolio of industry-leading power and sensing technology. So the company expected to continue to benefit from its longer-term growth markets. It's just hitting a bit of a cyclical downturn. And if we look at this stock over the last 5 years, it's now up about 235% versus the semiconductor market's 500% climb. And it's now trading roughly where it was at the end of 2021. So it's moved sideways over the last several years. It is trading below its 50-week moving average, but above its 200-week moving average. It found support there earlier this year. And then in terms of its 50-day and 200-day, it's trading below both of those and at roughly near oversold RSI levels. And it's trading 24% below its average Zacks price target. And then in terms of its valuation, it's trading 40% below its highs at 15.7 times forward 12-month earnings in near its 10-year median. And it's trading at a 60% discount to the broader Zacks chip sector or chip industry, which is trading at 40.3 times forward 12-month earnings. So that's a lot of that AI boom and AI expected growth that ON Semiconductor is not benefiting from. But long term, the momentum's on its side. Automotive sales went on a boom, and now they're slowing again. But long term, the markets in the automotive and industrial market that it's set to grow with, in the energy market, should bounce back. It's got a really great balance sheet, and it certainly is a semiconductor name that could be set to bounce back at some point, especially as more investors maybe start to take profits on names like NVIDIA and Supermicro Computer that are up just mind-boggling percentages in 2024 and maybe start to sprinkle their money elsewhere. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.